SBA loans don't work exactly how you think they do. Just this week, I was talking to a new referral partner. It's a large capital advisory firm, broker dealer out of New York. And we were talking about how SBA loans work because they've not really had quite the experience with those. They focus on other types of capital, but they're wanting to add SBA loans to the loans that they broker. So we were talking about that, how I used to run one of the largest SBA lenders in the state of Tennessee, and how the process works, because even people who understand finance and have a basic understanding of why the SBA exists, they still think it works a certain way. The first thing you need to understand is SBA loans are not grants. They're not free money. It is a loan that the borrower is taking on that they will have to pay back. The next thing I want you to grasp about SBA loans that is different than what most people think is, in a lot of cases, the SBA is not actually approving the loan. What they're doing is guaranteeing the loan. So if a lender makes, easy math for all of us, a $100,000 loan and it has an SBA guarantee on it, there is a percentage of that money that the lender knows that they can't lose, because if the borrower defaults, the SBA is just going to write a check and cover that amount. Now, the amount depends on the type of program you're in, 7A, whether you're in the Express program, that type of thing. But let's just use 50% as the number for math. If the SBA is giving the lender a 50% guarantee on $100,000, that means that the lender's really only at risk $50,000. And then if it's secured, they're at risk even less. So you can see how the SBA reduces the risk that the lender is making. That's really the whole point of the thing. But the SBA doesn't necessarily approve the loan. Now, depending on the loan amount, that can vary a little bit. When you get into larger loans, the SBA will have a process for the 7A program that the lender has to go through to make sure the SBA agrees with the loan. But in most instances, if you're working with a preferred lending partner, a PLP, that has been approved by the SBA, that's basically the SBA saying, hey, we approve of your loan practices, we approve of your policies and procedures, we approve of how you underwrite loans, and so we trust you to make your own decision. And that's a really big distinction that most people miss about how SBA loans work. Let me just repeat it. When you're working with a PLP, you're working with a lender who's already been pre-approved by the SBA to make these loans, and essentially they make their own decision about the loan. Then, depending on a few nuances, the lender basically just goes to the SBA, runs one or two checks, and it's a done deal. Now, when that's not the case, you are working with a lender who has to approve the deal, and then the SBA who has to approve the deal. And that's, generally speaking, why we see loan approvals and closings take a little bit longer, which is another myth that's kind of out there. There are some lenders who are not good at SBA loans. They're not good at lending in general. And so it takes a little longer to close a deal. But generally speaking, SBA loans don't take as long as most people think, probably 30 to 45 days, depending on the collateral involved. That may sound like a long time. And yeah, if you need money instantaneously, the SBA loan's probably not going to be right for you. Maybe you need to do an MCA, a merchant cash advance. Maybe you need to do a line of credit, something like that. But the SBA doesn't take that long, relatively speaking, for what could be a very, very large loan. So SBA loans are not grants, and you don't necessarily need the lender doesn't necessarily need the SBA's loan approval to do the deal. Now, another thing to understand about how SBA loans work is an SBA loan, and I alluded to this earlier, an SBA loan is not meant to make a bad loan good, okay? It's not going to get a lender to approve a bad loan. If it's a really good loan already, the lender probably doesn't need the SBA guarantee, although they might use it. Where an SBA loan works really, really well is in the middle, in the gray. When you get a loan that a lender thinks looks pretty good, but they have a few things that is making them nervous, they will use an SBA guarantee to sort of bridge their confidence in that loan. Remember the example, $100,000 with a 50% guarantee from the SBA, the lender's really only potentially out $50,000. You can see how that works. It reduces their risk and encourages them to make the loan. Won't make a bad loan good. Good loan should probably go conventional routes anyways because of fees that are associated with SBA. We'll talk about that another time. But a middle of the road loan is perfect for the SBA. It looks pretty good, but there's one or two things that make the lender nervous. It's just going to bridge them past it. Two instances to have in mind if you're going to get into the commercial loan brokerage industry where these loans make a lot of sense is two things. An SBA guarantee beyond the risk part for the lender. For the borrower, there are two places that it makes a lot of sense. Number one, you can make the loan term longer with an SBA loan than you could normally do. In some instances, there's loans that you would only do for 5 years. With an SBA loan, sometimes you can go longer than that. What that does is that will reduce the size of the payment, makes it more affordable for the borrower. The other thing an SBA loan is really good at is reducing the equity injection or the cash that the borrower has to put into a deal. Right now, I don't know if any SBA loans are going to have 0% cash injection, but depending on if you're buying an existing business and if the seller's going to finance or inject 5% into the deal, the SBA Loan 7A program is really good because it reduces the cash the borrower has to put into the deal. In a lot of conventional deals, you're going to be putting 20% into the loan. So if you're borrowing $100,000 to buy a piece of equipment, the borrower is going to have to come up with $20,000 and the loan will only be $80,000. With an SBA guarantee, it's theoretical to get down to 5 or 10% depending on the type of transaction. So if we use 10% and you're doing a $100,000 loan, well, that 10% injection is half of what would normally have to be put in by the borrower, and you're looking at a $10,000 deal. So you won't get down to zero cash injection as a borrower. So again, don't think that you can just go in and get an SBA loan and you're not going to have some quote unquote, we call that skin in the game, but it will make your term longer to reduce your payment size and it will reduce your equity. So these are some really important myths that have kind of been sticking out there that I still run into when I talk to people about SBA loans. They're really important for you to think about. As a commercial loan broker, SBA loans are not always right for everyone, but they are a perfect arrow in your quiver or ammo in your arsenal to use for borrowers who are not quite where they need to be, but they're still good enough with that guarantee that you can get the deal done. Good luck. Let me know if you have any questions.